Journal Entries, Chapter 2. We will walk through how to prepare journal entries, post them to the general ledger, and prepare an unadjusted trial balance. First of all, let's look at our accounting equation. Assets are equal to liabilities and owner's equity, but now we're going to incorporate debits and credits. DR stands for debit and CR stands for credit. We can see that the left side of the equation is the debit-based side of the equation, and assets increase generally with the debit. Liabilities and owner's equity is the right side of the equation and is considered the credit side of the equation, and generally liabilities increase with the credit. Now the challenge is, and I will go through this more later on, is owner's equity, which stands as a credit balance, but we can see when we go through them that the debits and credits go back and forth. So let's go back to the assets, which generally increase with the debit. So we can see that cash, accounts receivable, supplies, prepaids, and equipment all increase with the debit, and they're also assets, and assets are only found on the balance sheet. Liabilities also are only found on the balance sheet, and accounts payable, unearned revenue, salaries payable, and notes payable, we can see that each one increases with the credit. So what we've learned so far as as our accounts is holding true. Now let's look at the challenges that we have with owner's equity. Not only do the accounts belong on different financial statements, but the debits and credits switch back and forth. So generally owner's equity increases with the credit. So let's look at the things that increase owner's equity, such as owner's capital, ending owner's capital, which is found on the balance sheet and the statement of owner's equity. It increases with the credit, decreases with the debit. Same thing for revenue and sales, which are only found on the income statement. They increase owner's wealth, and they increase with the credit. Now owner's withdrawals, which is only found on the statement of owner's equity, it increases with the debit, which indirectly affects the credit balance in owner's equity. So owner's withdrawals increase with the debit, and expenses increase with the debit, and expenses are only found on the income statement. Now let's look at the normal balances of accounts. So the normal balance is whatever balance increases an account. So I have under the DR all of the accounts that their normal balance is a debit, and that would be assets, withdrawals, and expenses. All those accounts which increase with the credit, and the credit would be its normal balance, would be liabilities, owner's equity, and revenue and income. And we can even abbreviate it even further with DRCR and accounts, assets, liabilities belonging on the balance sheet, owner's capital belonging on the balance sheet and statement of owner's equity, withdrawals belonging on the statement of owner's equity, expenses and revenue belonging on the income statement. Now I call this my legal cheat sheet. There's no way you can bring that into an exam, but also too, if you want to, if you memorize this, when you go to an exam, you can immediately put this on your exam and refer to it as you're taking a test. Now let's look and see how to write journal entries for our example. So here we have an owner that is investing in a company. So the company receives an investment by the owner of $30,000, and so we can see that cash, which is an asset, would increase with the debit, so cash is increasing, and owner's capital is also increasing, and when it increases with the credit. So what we do is we always write the debit first, and then we write the credit, but we indent it a little bit, and you can see as we go through this that it's much easier to read the debits and the credits when we indent our credit just a little bit. And again, the debit always goes first. Next, we purchase some supplies for cash for $2,500, so our supplies as an asset increases with the debit. Our cash as an asset decreases with the credit. Next, we're going to purchase some equipment for cash, and so equipment is an asset, so it is increasing with the debit. Our cash as an asset is decreasing, so we're going to be crediting it. Next, we're going to purchase some more supplies, but now we're going to use accounts payable in order to pay for it. And so now our asset supplies is increasing, so we're going to debit supplies, and accounts payable is also increasing. It's a liability. It increases with the credit, so we'll be crediting accounts payable. Next, we have providing services for a customer, and they pay us in cash, and so our cash is going up. We're going to be debiting cash, and then we're going to be crediting consulting revenue, which is increases with the credit. We're going to pay the rent for the month, and so it's going to be an expense. It doesn't provide future benefits like the supplies, which provide future benefits. So we have a rent expense, which increases with the debit. Our cash as an asset is decreasing, so it's going to decrease with the credit. Next, we're going to pay salaries. Salary expense increasing with the debit. Cash is decreasing with the credit. We're going to provide consulting services and also provide a rental to the same client, and it's going to be on credit, so they're not giving us cash, so we'll have an accounts receivable associated with this, which is a promise to pay. So accounts receivable is an asset, so it is increasing with the debit. Revenues are increasing, so they'll be increasing with the credit. Next, our client's going to pay us for the bill that we sent them for the revenue and the rental. The services and the rental. So cash is going to increase $1,900, and accounts receivable as an asset will be decreasing by $1,900. Next, we're going to make a partial payment on accounts payable in the amount of $900. So accounts payable is typically increases with the credit, but when we're decreasing it, we will debit it. Again, the debit goes first. Then we're going to be decreasing cash, crediting cash. So crediting cash for $900. Then we're going to have a withdrawal of cash by the owner. So withdrawals increase with the debit, so this increases withdrawals with the debit, and cash is decreased with the credit. Now let's transfer these accounts to our T accounts, or our general ledger. We had a receipt of cash for future services, so we recognize revenues when we earn them, and so here we have cash that we received for future services. We haven't earned them yet, so we're going to recognize the receipt of the cash. So cash is going to increase by $3,000, but now we have a new liability called unearned revenue. It's going to be credited since liabilities increase with the credit. Now a word about unearned revenue. It is a liability, so if this client were to call us back the next day and say they want their money back, we would have to give it back because we haven't earned the revenue yet. So it's a liability. It's amounts, it's services that we owe in the future to this client. Here we have prepaid insurance. We're going to pay cash for future insurance coverage in the amount of $2,400. And so now we have an asset because it's going to benefit future periods. So it's an asset, prepaid insurance of $2,400. So the asset is going to increase with the debit. Cash is going to decrease with the credit. Now a word about prepaid insurance. If this had only been insurance for the month, it would have been insurance expense, but since it's going to benefit future periods, it's an asset. Now we're going to buy some more supplies for cash. So supplies will increase, they're benefiting future periods, so it's an asset, and cash will decrease with the credit. We're going to pay our utilities for the month, so it's utilities expense, and our cash is going to be decreased in the amount that we're paying. And then we're going to pay some more salaries, so it's salary expense, and it's going to be increasing with the debit, and our cash will be decreasing with the credit. And so now let's look at transferring these amounts to the T accounts. So we can see here that on the left side, this cash is increasing with the debit and capital is increasing with the credit. Now let's look at all of these. Supplies are increasing and cash is decreasing. So decreasing with the credit, increasing with the debit. Equipment is increasing with a debit, cash is decreasing with a credit. Supplies are increasing with a debit, and accounts payable are increasing with the credit. Cash is increasing with a debit, and our consulting revenue is increasing with the credit. Our rent expense, our cash is decreasing with the credit, and our rent expense is increasing with the debit. Salary expense is cash is going down with the credit, and salary expense is increasing with the debit. Accounts receivable increasing with the debit, consulting revenue increasing, both consulting and rental revenue, with the credit. Cash, we're being paid for our accounts receivable, so our cash is going to increase and our accounts receivable will decrease, and it comes up with a zero balance. Accounts payable, our debit, we're paying down our accounts payable, so normally it's a credit balance, so we're going to be debiting it to decrease it, and our cash is going down by $900, so we'll be crediting it. Owner's withdrawal, will be debiting owner's withdrawal for the withdrawal, and it increases with the debit. Cash is decreasing with the credit. Now we have our unearned revenue. Our cash is going up with a debit, and our liabilities are increasing as unearned revenue with the credit. Our prepaid insurance, the asset prepaid insurance, is increasing with the debit. Cash is decreasing with the credit. Supplies increasing with the debit, cash decreasing with the credit. Utilities expense increasing with the debit, cash decreasing with the credit. Salary expense increasing with the debit, cash decreasing with the credit. Now let's look at balancing our T accounts. We always do the same three things when we balance a T account. We add up all of the debits, we add up all of the credits. So this is the total of the debits, this is the total of the credits. Then we take the smaller from the larger, and that's our ending balance. So add up all the debits, add up all the credits, take the smaller from the larger, and that's our ending balance. And we can see that too with accounts payable here. So this is our total of our debits, this is the total of our credits, take the smaller from the larger, and that's our ending balance. So now let's transfer these amounts to our unadjusted trial balance, and we can see that really the hard work is doing the journal entries. That's where you really have to do the thinking in order to determine what should be debited and credited. But if you use your legal cheat sheet, this ability to debit and credit correctly will be much easier. So then all the rest of it is just carefully transferring these amounts to the individual T accounts. Just be careful. I advise doing the transaction by transaction so that you won't get turned around, and if you try and do all of the cash at one time, you may overlook one. So I advise doing them transaction by transaction, and then all you have to do is just double check yourself and then make sure you add up all the debits, add up all the credits, and take the smaller from the larger. Now we just have to transfer these ending balance to the unadjusted trial balance. And so what we're going to do is look and see if these are normal balances. So this is our cash balance. This is our office supplies balance, prepaid insurance, equipment, accounts payable, unearned revenue, capital, withdrawals, revenue, and our expenses. And we look to see, are these normal accounts? Well, cash increases with the debit. Or it's an asset. So office supplies, an asset, increases with the debit. Prepaid insurance, debit, increases with, normal balance is a debit, increases with the debit. So that looks normal. Same thing for equipment. Withdrawals have a debit balance, so we're expecting to see a debit balance. It increases with the debits. We're expecting to see a debit balance there. Same thing for these expenses. Now, what increases with the credit? What are normal balances would be all of our liabilities, which are accounts payable and unearned revenue, our owner's capital, and also our revenue account.